Hello everyone, this is Peter Harris from Commercial Property Advisors, also author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many commercial real estate investors all across this great nation of ours. The title and subject of today's video is Distinguishing Good Deals from Bad Deals in Commercial Real Estate. I get the pleasure of reviewing hundreds of deals every month for myself, for my students, for my clients, from brokers, from agents. You name it, I get to review it. Here's what I'm saying. Some of you are about to get into some bad, awful deals, and I'm here to help you today. Now, the reason why you're doing this is because you cannot distinguish between a good deal and a bad deal. And on the other hand, some of you are very smart, but you suffer from analysis paralysis. You won't pull the trigger. Now, even if a good deal stared at you in the face, you still won't pull the trigger. But I believe if you can distinguish between a good deal and a bad deal, you will pull the trigger. So in these next few minutes in this video here, I'm going to share with you what good deals look like on the surface and what bad deals look like on the surface. And in those same examples, what good and bad deals look like underneath the surface. All right, so you won't find any of this in any textbooks. So let's get started. What is a good deal and what is a bad deal? I have this first example here, and we're going to go through it real quickly, and then we're going to determine as a team if this is a good deal or bad deal. All right, here's the deal. It's a 20-unit apartment building, good condition, good neighborhood. Rents have not been increased in 4 years. Owner is in retirement or retirement age, owned property for 21 years, plans on moving out of state, right, closer to the grandkids. Number 4, the property is owned free and clear, meaning there's no mortgage. Aha. And number 5, the owner self-manages the property and is friends with the tenants. Now, before we get into whether this is good or bad deal, we teach our students how to find sellers without the brokers. And you will not believe how many of these type of deals that we find. So back to the determination. Is this a good deal or a bad deal? What do you think? Well, in my opinion, this is a good deal. Okay? Here's why. All right? Number 1, it's in good condition and a good neighborhood. So in our program, we want to find good properties in good neighborhoods. So that's number 1. Number 2, the rents have not been increased in 4 years. What does this mean? Very obvious, right? That means that the rents are due to be increased. Remember, in commercial property, as your rents go up for a given cap rate, the property value goes up. That's only in commercial. Number 3, I love this one. Owner is retirement age, owned property for 21 years, plans on moving out of state closer to grandkids. What does this mean? If you guys have watched my previous videos on creative financing, we structure creative deals around the seller's motivations. This is a huge seller motivation. He's elderly, retirement age. He's owned the property for 21 years, probably done with the business. And look at this. He wants to sell because he wants to move out of state closer to his loving grandkids. That's huge motivation. Number 4, property owned, free and clear, no mortgage. Why is this a good thing? Well, it's a good thing because when a property has no mortgage on it, the seller can be the bank for you. We can do a master lease, we can do an installment sale, we can do a number of things to make this deal work for you if we need to do it creatively. And number 5, the seller self-manages the property, meaning that there's no property manager, he manages everything himself, and he's friends with the tenants. That's not a good thing. So when a combination of self-management and friends with tenants means that the property is not optimally operated, meaning that there's money left on the table, meaning there's more money to be made by a new owner. Okay? You got it? All right, so this is very common in our company here that we're able to find these type of things. So this is a good deal. In the spirit of keeping things going, let's get to the next example. Here is the next example. Is this a good deal or bad deal? All right, here it is. It's a 20-unit apartment building in the worst part of town with the highest homicide rate. However, it's a 10 cap. So remember, 10 caps potentially produce a lot of cash flow. Number 2, he's an out-of-state owner and has been through several property management companies. So there's probably potential here in hiring the right manager, right? Number 3, the property is 60% occupied, but all the units are rent ready. So there's a potential 40% upside here. Number 4, the owner is open to creative financing and is very motivated. We love motivated sellers, so we can put together some really awesome deals if the owner is motivated, and he certainly is here. Lastly, the property has been owned for almost 2 years. He just bought it. So knowing what you know here, is this a good deal or is this a bad deal? Which one? What do you think it is? Well, in my opinion, this is a bad deal. Very bad. Let me explain why. This is a very popular deal that you can find all over online through brokers, by yourself. You can find a lot of these deals. Let me share with you what's wrong with this deal. First of all, it's in the worst part of town with the highest homicide rate in the state. Let me say this. You may want to write this down. You cannot manage your way to success in a bad neighborhood. You cannot manage your way out of a bad neighborhood. No matter what amount of skill you bring with the property management and your skills, you will not be successful. It's not about you or your skills or your team. It's about the culture of their neighborhood. It is not conducive to real estate investment success. So if you are a beginner, don't even try it. All right, the other thing is we tend to get caught up with the cap rate, right? We'll see on the listing it's 10% cap, and we'll do all the calculations and we'll see how much cash flow this 10 cap can bring in. But in actuality, there's no cash flow. And there's no cash flow. It's because it's in the worst part of town and you're getting not so good tenants that don't pay on time. Don't be fooled by this. Number 2, the owner's out of state and has been through several property management companies. So the question is right away, why has he gone through several property management companies? Why don't they stick at the property? Well, it could be several reasons, right? But probably not very good reasons of why it's there. So that's not good. Number 3, if the property is 60% occupied, but all the units are rent ready. You would think that you could fill these units with the remaining 40% and achieve great cash flow. But my question is, you're 60% occupied. First of all, why? Especially if the units are rent ready. So why are they rent ready but not occupied? Okay, so it makes you think, right? Number 4, the owner is open to creative financing. Very important. This is very important because a lot of you out there, you have gotten into very bad deals because the agent or the seller wanted to do something creative and you were very creative in structuring a deal, right? A very good deal on paper that looked really good, but you forgot about this. Again, you cannot manage your way out of a bad neighborhood. Got it? Lastly, the property is owned for almost 2 years. So right away, my first question is, wow, he wants to sell after 2 years. What's wrong? Number 2, if we were to do this deal, because it's only 2 years old of ownership, the equity is probably not there. So you may be over leveraged in this type of deal. Very dangerous. All right? So you got it? So this is a bad deal. It's a very common deal out there. All right? So let's jump to the next example, okay? All right, here is the next deal example. Is this a good deal or is this a bad deal? Here's the details. It's an office tower, Bixby Office Towers. Been around for a long time. It's a well-known name, well-known office building. Well, it was purchased via REO from a bank for a very, very low price. Probably paid all cash for it, and it's a very, very low price. Number 3, the cap rates in the area are increasing. Number 4, there's lots of deferred maintenance on the property, with some of the areas of the property being obsolete. And lastly, nearby office building, a new one is under construction. So given what you know here, you bought it for a low price, the cap rates are what they are, you got some deferred maintenance here, but you bought it for a low price. So is this a good deal or is this a bad deal? What do you think? Here is what I think. I think this is a bad deal. Very bad. Let me share with you why. Number 1, it was purchased via REO for a very low price. That's a good thing, but the cap rates in the area are increasing. And remember, when cap rates go up, property value goes down. So what's going on in this area where the cap rates are going up. What's causing the cap rates to go up? I don't know. For us real estate investors, when cap rates go up, the property values go down. It's not where we want to be. The second thing is there's lots of deferred maintenance on the property with some areas that are obsolete, right? So when a commercial property, especially an office building, has some obsolete areas, it's a whole lot of money to make them not obsolete. So because they're obsolete, you're not going to attract the best tenants and the highest and best paying tenants. The last thing, the third problem I have with this deal is there's a nearby office building under construction. Given the problems that we have here 1 through 4, this new office building, if priced correctly, could take away and keep away your best tenants. What's the lesson here? The lesson here is this. It's not always good to chase low price deals. It's not always good to chase low price deals. So get that inside you. Let's move on to the very last example. Okay, here is the last example. It is a 112 unit apartment building named Cherry Villas, and it's well maintained. Number 2 is 97% occupied. There's a waiting list most times. 97% occupied means that roughly 109 units are occupied. That's a good thing. A waiting list means that it's a very desirable place to live. People want to move inside, and so many that there's a waiting. Number 3, excellent top-notch property management company. I know that to be the case because of these 1 and 2. And number 4, the property Cherry Villas is located in an established, growing area of town. So that means that the property is in a strong area to draw in tenants to move in and pay rent and create cash flow for you. So this is a good deal, right? And I'm sure all of you agree with me on this deal that it is a good deal. Now, I want to share something with you that when you see deals like this on any commercial property that's working well, that means its essential elements of success are all working together. I call these essential elements of success the 4 M's. Let me explain. M number 1 is money. You need to have cash flow management in every commercial property. Number 2 is marketing. You need to have a strong marketing presence to make sure the property is positioned and presented well to the public. The third M is maintenance. Maintenance is important for 2 things. Curb appeal. When a potential tenant drives by, the property needs to look beautiful. And the second thing good maintenance does, it helps you with tenant retention. When you have poor tenant retention and people moving in, moving out, that costs you a whole lot of money. Good maintenance means that people are going to stay there because they feel taken care of and safe. The 4th M is, so that's management. So every good place needs to have good management. Now, I can tell you from my experience, every piece of commercial estate that works well, that's cash flowing well, that's operating at a high level, has its essential elements, the 4 M's, also operating at a high level. Conversely, if you find a commercial property that is distressed or not working well or just broken, it's because, I guarantee you, one of these 4 M's is not working. Let me give you a quick example. I can take any one of these M's here, take them away, and watch the whole thing collapse. Let's say that the maintenance arm is broken, so we can't tend to the tenant's needs, the curb appeal isn't great. Now when that happens, what gets affected? What gets affected is your marketing. You can't market a property that's poorly maintained. Tenants are unhappy, they drive by, curb appeal is awful, they can't market the property properly. What does marketing affect? Marketing affects the money. You can't bring in the money to have effective what? Management. Got it? Okay, so this is like a 4-legged stool, the 4 M's are. Because one is broken, the chair falls over. This whole thing collapses. Again, every high operating commercial property has the 4 M's working well. All right, we're at the end here, and I'm hoping that by now, after these few minutes and after the 4 examples, that now you are better versed in determining what's a good commercial deal and what's a bad commercial deal. I want to end this video by sharing with you a quick summary and also tips you can rely on. So let's do that. Number one, always look for upside and seller motivations when considering deals. Upside allows you to create value, increase the value in the property, while motivations help you leverage, increase the value and help you leverage. Very important for these two things to have in each deal. Number two, as I mentioned, you can't manage your way out of bad neighborhoods. Don't even try, okay? Take it from me. Number three, it's not always good to chase low price deals. Some of you may be attracted to the low price and the potential high returns. Most times, their high returns do not exist. Number four, success and failure are underneath the 4 M's. And the 4 M's are money, marketing, maintenance, and management. You need 4 of those to be successful in this business. Let's end it right there. I hope you enjoyed this video. If you want more videos and more training like this, please go onto our website, commercialpropertyadvisors.com, and don't forget to subscribe to this YouTube station. All right, thank you for watching Distinguishing Good Deals from Bad Deals in Commercial Real Estate. I'll see you at the next video.